The dollar is ticking higher today, but has weakened significantly so far this year. With earnings season coming into full swing, how much of an effect can we expect the weakening dollar to have on companies? Joining us now, we've got Christian Lawrence. He is Rabobank's senior cross-asset macro strategist. Christian, it's great to have you this morning. Talk to me about which companies might stand to benefit from a weaker dollar this earnings cycle.
It's great to be here. And certainly, that dollar story has, I think, a little bit further to run. And we're seeing a little bit of strength today, but I think that's really month-end flows. Now, when you look at the impact on the corporate world, it is, of course, those that are more externally focused that are going to be most vulnerable to these moves that we're seeing. I think when you're thinking about the tariff story in general, we can divide the corporate world into those that are more domestically focused and those that are more international in nature. And that's likely to come out in the earnings data that we see coming up from not just the first quarter, but throughout this year.
One thing I've been hearing a lot is that the dividend-paying stocks tend to benefit from that weaker dollar. To what extent do you think that is a big enough lift for some of those names versus just, sure, it's a cherry, but it's not really going to change the story?
Yeah, I mean, I think in general, the dollar story isn't going to be the main driver of earnings at this juncture, right? We're seeing huge shifts when it comes to consumer confidence. That's likely to play out in terms of those consumer companies, I think, are going to be the real focus of earnings season, simply because that is the more forward-looking indicator as to how the tariff are going to impact the growth story of the US, because that's one thing we need to keep in mind constantly, and that is that the US is a consumer-driven economy, and what the consumer does is really the fate of economic growth going forward.
Mm-hmm. Yeah, that's true. And I think that's a great point, too, considering that international markets have a different sector makeup. I think people forget all the time that, the biggest sector in the European markets is banks. It's not tech, even though tech dominates our lives over here. So, Christian, I have a question on on like a more major asset allocation perspective, because one thing that we think a lot about at Ritholtz is how to prepare our investors for an environment where U.S. exceptionalism is fading, very, very slowly, but still, a trend to watch. How quickly do you see this happening? What are you seeing in your world in terms of demand for U.S. assets and where it's going?
Yeah, I mean, I think that's the top question at the moment, right? And I think there's a few elements here, and I think there are a few misreads that we're seeing. So when we talk about the unwind of the dollar trade, we need to remember that it was such a consensus trade for so long, and this legacy position is starting to unwind, and it probably does have further to go. But we're coming from extremes. I think the other story is, of course, when you think about currencies, is always a relative story. And what we've seen in Europe is a huge shift. Taking off the fiscal brakes, a huge surge in spending, that resulted in this mass repricing of the euro. So it makes sense that we're seeing a little bit of dollar weakness. Now, the idea of US exceptionalism fading, that certainly seems to be the narrative at the moment. But I do think we need to bear in mind that moving away from the dollar is not something that the world can do in the short term. It's not something that can happen easily. Yes, we may be seeing policies in place that are encouraging countries to look elsewhere, but it is so deeply ingrained. When you look at demand for dollars outside of the US, it's around 10 times the availability of dollars, and it's still the lifeblood of finance, the lifeblood of trade. So while, yes, we are seeing a bit of weakness, we're seeing correlations in US assets, whether it's equities and the US dollar have increased and gone back into positive territory, yes, we can continue to see this for a bit, but this is not the death of the dollar, not by a long stretch.
Do you feel the same way about the bond market in the States?
I mean, I think the bond market, we are in an environment now where there are essentially a huge range of stackable binary geopolitical outcomes that have wildly variant implications from a macroeconomic standpoint. And to be blunt, it makes median forecasting almost pointless right now. We have to look at these different scenarios and judge how we're veering between them. And I think that's the environment we're in. I think what is really interesting, though, and does fit with that fading of exceptionalism story, though, is when you look at baskets of how currencies have performed. No surprise, because of euro strength, we've tended to see Eastern European currencies perform well, but we've also seen the yen and the Swiss franc perform well, those typical safe havens, and the dollar has not been in that bucket this year. So that's the real breakdown in that correlation that I think is particularly interesting.
Yeah, so I'm a Fed nerd. I think about this a lot, but how do interest rates and monetary policy work in here? A lot of central banks across the world are cutting rates. The Fed is obviously on hold, and we'll probably need to see some kind of actual weakness in the data to make a move. So how do we see that divergence coming through in the currency market, and how do you prepare your portfolio for that?
Yeah, and I think, look, when we talk about the Fed, I think the market has got ahead of its skis a little bit. We've got about 3.5 cuts priced in by the end of the year. And yes, we can see a negative growth environment. We can see a higher inflation environment. Stagflation is, of course, the very big fear at the moment, and that's a very difficult environment for the Fed to navigate. But I think it's important to note, when we say there's 3.5 cuts priced in, that means really it disguises a lot of differing views below the surface. There are some that are pricing in for essentially cutting rates almost down to zero, and some that are expecting no cuts at all. So we need to be aware that that's just the average of the views. And because of these stackable binary events I mentioned, the truth is a much wider scenario. Now, my base case is that the Fed isn't able to cut that much, and we're more likely to see a very cautious approach, as you just alluded to. When you talk about the longer end of the curve, though, this is just going to be whipping around something ridiculous, because we have term premium being built in, then we have lower growth expectations. I think we can see the 10-year at 4% and 4.6% within the pace of a few weeks, quite frankly.
I saw that in your note, and I wanted to ask you about that. Like, can you pick one? Like, which one do you think is more likely, a lower 10-year or a higher one? And to the point of when the Fed might cut, if at all, does that not require a slowness that investors also wouldn't like, that is potentially indicative of a recession? And that makes me wonder if you are seeing recessionary activity in any of the assets that you're tracking.
Yeah, I mean, that's the question, right? Because what have I told you? It might go up and it might go down, which isn't that helpful. Look, my bias is it is this battle between term premium because of the uncertainty, but also these diminishing growth expectations. Now, I do tend to think it is going to be this wild ride. So in the short term, I think 10-year yields, we can see a little bit more upside. But when we start pushing further out and we start to see the consumer sentiment data turn into weaker actual data, that's when we can see a little bit more pressure on the long end.
And one more to kind of put a bow on this. You mentioned a couple times kind of these traditional correlations breaking down between asset classes. What's the trade that can initiate as a proper hedge? Is there something investors can be doing to profit off of that dislocation that we're seeing?
Yes, but it's about being opportunistic. It's about being nimble. If you're a long-term investor in this environment, you can't try and play these sort of breakdowns and returns in correlations. You do have to take a much longer-term approach. So I think it's only really relevant for those fast money accounts that are able to be so active. And it's a question of just jumping on the momentum. But once you've got some profits, take those profits off the board. You can't be greedy in this environment, and trying to hold a position for 1 or 2 months is particularly difficult.
Yeah, have a plan and stick to it. Thank you so much, Christian. Really appreciate you joining us. And of course, our thanks to Callie Cox for joining the conversation as well.